Welcome back to part 3 of our video lecture for chapter number 8. In this part 3, we're going to look at the sale of business property. Probably last semester in Accounting 134, you had learned about the sale of investments, capital gains and losses. So this is a review here, calculating the gain or the loss. You start off with the sales price. This is all the benefit you're going to get when you sell something, and you're going to minus out the cost of selling this thing, things like commissions, maybe some type of closing costs. And the remainder is called not the gain, but the amount realized. And you don't pay taxes on this amount realized because you get to deduct any remaining costs of the asset you just sold, called the adjusted basis. The adjusted basis is equal to the initial basis you started off with. Maybe this is the amount you had paid for, the cost of what you had just sold, or some other alternate initial basis. Then we subtract out from that initial basis all of the depreciation we've been learning about in the past videos. We group it together into a figure called accumulated depreciation. And then the remaining basis left over is that adjusted basis we subtract out from the amount realized to get the gain. And of course, we know we pay taxes on the gain. Or if the result is a loss, a business loss, we get to deduct this on our tax return, reducing our taxes. Now, of course, economically you want gains, but if there is a loss, that's good for tax purposes because we get to deduct that. Now, what you sell can be divided up into maybe 3 broad categories. In the case of a business, the main thing they sell is maybe inventory or services. So when they sell those items, you're going to get what we call ordinary income or ordinary losses. And those ordinary income get taxed at ordinary tax rates. The rates could be as low as 10%. And if you're in the high individual tax bracket, the rate can go all the way up to 37% for federal taxes. And of course, you would tack on even more for state income taxes. The typical example again is maybe you selling inventory, resulting in ordinary income, ordinary loss, getting taxed at these regular marginal tax rates. Now again, last semester, maybe you learned about selling investments, resulting in a capital gain or a capital loss. You also learned about maybe something called short-term or long-term gains and losses. And if it's a long-term capital gain, like an investment you held for more than a year and you sell it, or maybe even your home and you sell it, the potential is the long-term capital gain tax is either at 0 or for moderate taxpayers maybe 15%. And if you're in a high tax bracket, your long-term capital gains gets taxed at 20%. Okay, lower than the marginal rates for ordinary income. So again, you have ordinary income, capital gain income, and now in this chapter we focus on business property. Sometimes we call this section 1231 property. Typically is the business property that you can depreciate. That again we've been learning in this past couple videos. And also the asset that you cannot depreciate if it's in your business, the land asset, is also 1231. Again, being used in your business for business purposes. Now, if the land is not being used in a business purpose, let's say just raw land, maybe it's an investment property, a capital asset. So there's no specific rate for gains and losses for section 1231 assets. What we're going to do is if it's a gain, we're going to treat the gain as long-term capital gain. It gets taxed at those lower rates. And if the result is a loss, the loss is going to be deducted at these higher rates. Okay, so that's the general rule we're learning here for section 1231 business property being sold. Now, there's always exceptions to these general rules that we'll see in the next few slides. So again, let's define Section 1231 assets. Assets that are depreciable, including land costs, that's not depreciable. These other items listed here are not common. These are for specific industries, but they're 1231. And all of these assets have to be held for more than a year. Now, if you held it for a year or less and you sell it, probably they'll turn it back to ordinary assets for your business. The assets we're talking about held for more than a year, then you sell it, resulting in a Section 1231 gain or loss. So you figure out the gain and the loss for each business asset you sold during the year, and you combine them together. We call that netting. So if the result is a net 1231 gain, we saw the general rule is to treat that gain as a long-term capital gain, again taxed at that 0, 15, or 20% rate. If combining all the 1231 gains and losses, you end up with a loss, then the loss is treated as an ordinary loss, which is good because you get to reduce that ordinary income that's taxed probably at the higher marginal rates. So it mentions here you get the best of both worlds. But we know in taxes there's always exceptions to these general rules. So one of the exceptions is called depreciation recapture. This applies to gains, yeah, not losses, and it applies to either personal property, the stuff that's not real estate, and to the extent we have depreciation on personal property, that may turn the gain on these sales, again we call it recapture, called 1245, turn the gain on the sale of this personal property into ordinary income, not treated as capital gain. This recapture, which is not common anymore, is for real estate, Section 1250. But then we'll find out there's something called unrecaptured 1250 gain in a couple of slides from now. So let's focus on that personal property recapture. So we've seen in previous videos, here's your 7-year class life for depreciation. Here's your 5-year class life for depreciation. That's personal property. This real estate here, not common for most people. They didn't buy and place into service non-residential property back then. Yeah, so we don't see much of this. Yeah, but this is very common here. Depreciating personal property. And again, to the extent you have a gain, the gain will be recaptured to the amount of depreciation you took in past years for that property. If you have even more gain than the depreciation, any excess gain taxed now at that long-term capital gain rate. Let's take a look at an example where we have Francesca. She bought a property a few years ago at a cost of $50,000. Oh, sorry, this is the sales price. She bought it a few years ago at $60,000. And over the years since then, she's been depreciating it for $25,000 total. So that means what's left over, the so-called adjusted basis, costs minus the accumulated depreciation. She gets to subtract out $35,000 when she sells it. So the $50,000 sales price minus the $35,000 adjusted basis gives us a gain of $15,000. And if you apply the general rule that we had learned here, that Section 1231, Section 1231 gain taxed as long-term capital gain. But because we have recapture here, to the extent of depreciation taken, all of this $15,000 will be taxed as ordinary income. Again, we call this Section 1245 recapture, recapturing the depreciation to the extent of the gain. And the reason for this is that when she deducted this depreciation over the years, she was able to reduce her ordinary income by that depreciation, reducing it by those high tax rates. But now, if she reports this gain as long-term capital gain tax at low rates, that would be unfair. So to the extent you have a gain, you gotta return it into ordinary income up to the amount of depreciation. So in other words, if she only took 10,000 depreciation or was allowed 10,000 over the past years and had a $15,000 gain, 10,000 of the 15 would be recaptured as ordinary income. And the extra 5,000 of gain taxed at long-term capital gain rates. Okay, let's move on to the next one, which is 1250. And 1250 recapture really don't apply anymore because it only is used whenever there's something called accelerated depreciation. And we've seen in the past calculations for depreciation, only straight line was being used for real estate. Again, real estate in the past years could be deducted not quite like the double declining we learned for personal property, but a faster rate, not applying anymore. So here it says it really is used, it really applies anymore, this 1250 recapture. But again, there's an exception to this exception called unrecaptured section 1250. Okay, so we don't recapture 1250 anymore, but then any of the depreciation, we're going to turn that into ordinary income up to, well, let's see. We saw that regular rates were something like 10% in the first bracket. This is an old slide. This should be 12%. Then the next rate goes up, I think, to 24% and then 32%. Real estate gains will be turned into ordinary income all the way up to the rate of 24. Once you go over 24, then a 25% rate will kick in. And that will be, again, all to the extent of any depreciation. Okay? So if your gain falls all in this bracket up to 25%, all tax at this 25%, these rates here. And then anything over, again, more depreciation than you gain, tax at 25%. The best thing to do is take a look at this example here. We have a Ella, the taxpayer, who bought a real estate. Okay, it doesn't matter whether it's residential or non-residential. The initial cost was 7 million. And again, only straight line here, so we're not going to have that 1250 recapture, but we're going to have unrecaptured depreciation, tax possibly at a maximum rate of 25%. So we're told that the sales price is 8.5 million. So we go through the calculation of figuring out the gain. That's initial cost of 7 million minus out the accumulated depreciation of 6.1 million, leaving us a basis, adjusted basis of 900,000. And we subtract that out from the sales price to get a gain of 7.6 million. And again, we're going to turn that gain into unrecaptured gain up to the amount of depreciation taken. But then that gain will only go up to be taxed at a maximum rate of 12%. This is an extreme, and we're talking millions, but for most taxpayers, when they do sell property, they'll probably have a gain, maybe 100, 200,000. So they're still going to be within probably this lower brackets here. But once they reach a bracket that takes them over 24%, the maximum gain will be taxed only 25%. And we're only talking gain to the extent of depreciation. If you have more gain than depreciation, then the excess gain taxed at capital gain rates. Again, kind of hard to work with here, but most of this type of gain and losses are calculated on a form called 47.97. And this unrecaptured gain, you have to use a worksheet probably on this 47.97 form to make sure you're using this 25% rate correctly. Let's move on to another type of gain or loss, and that's when a business property gets destroyed. Now, it's possible to have a gain when property is being destroyed because you may be collecting insurance. You may be collecting a judgment fee. And again, the general rule is gains are taxable and losses are deductible. But if you get money and you're going to use it to replace your destroyed property, possibly you don't have to report the gain, you can defer it. Not tax-free, but you're going to defer it. Here it mentions that you have up to maybe 2 years to buy a replacement property to be able to postpone the gain. And the way we do that is to reduce now the cost basis of the replacement property. So you're going to get less depreciation on that replacement property, or maybe more gain when you sell that replacement property. Okay, so that's uncommon because most times you're not going to have this situation, yeah, but you have to be aware of it. Okay, so I've seen situations where there's a government condemning property, like maybe you want to build a freeway through it, or I've seen accidents, major accidents like a helicopter being destroyed. Let's talk about one more way of selling property. So again, the formula was sales price minus the adjusted basis equals, in this case, we only look at gains. And we would have to report tax on the gain. But let's say that you don't collect all of this sales price at the time you sell the property. The general rule is that you may have to report all this gain here, pay taxes on it. So to avoid that situation, we don't have money to pay taxes. What you can do is report the gain, report this sale using something called the installment method, installment sale on this form. So generally the way it works out is if you collect half the sales price, then you have to report half of the gain. If you collect in any 1 year maybe none of the sales price, then none of the gain has to be reported. Okay, so that's installment sale. And I won't test you on, or at least apply it on a project here for this. Maybe we'll see a few questions as the general concept. But if we come across a problem where it asks you to calculate out the installment sale, I'll actually probably will give you the form, this 6252 form, and then you can plug it into the tax return. Okay, let's stop here and make sure you read the chapter. These video lectures are only a supplement for you to read the chapter. And then you do the homework assignments and you work on eventually a tax return project. And we end every chapter with a quiz. Yeah, that'll be a week or so from now. Okay, if you have any questions, make sure you email me.